Hi everyone. So today we're going to be looking at unearned and accrued revenues. So whilst unearned revenues might be a new thing, realistically they aren't too dissimilar to things we've looked at in the past. We have been given money and in return we owe a service. So because there is an obligation there, it's going to be a liability. As for accrued revenues, this is actually something that you've seen before. We have accrued revenues when we've taken on credit. So the way that we handle these things is very similar to the way we handle accounts receivable, but the only difference is that we're looking at revenues like interest and things like that. So let's jump in and see how we do this. At the basis of this, just like with our balance day adjustments relating to our expenses, we have to remember that accrual accounting focuses on the calculation of profit using net profit equals revenue less expenses, or revenue earned less expenses. That means that to accurately calculate this, we have to include all the revenue that we have earned in the period. Just the same way that we accrue expenses and we prepay some expenses, and we have to do some special treatments to these, same way we have to handle accrued and prepaid revenues. Now, accrued revenue is pretty similar to what we've already done. It's revenue that we've earned, but we haven't yet received. A really good example of this is if we have a term deposit. So in this example, a business invested $10,000 in cash into a term deposit for 12 months at 5% per annum on the 1st of July 2023, and the reporting period is on the 31st of December. So realistically, we know that we've earned 6 months of interest on this account, but we won't have actually received the cash because the term deposits don't pay out until the end date. As a result, because we can accurately say that we have earned that 6 months of revenue, we have to account for it because it does impact our net profit, despite the fact that we haven't actually received that cash. So we make the following adjustment entry. So we're increasing our interest revenue, and we're also increasing our accrued interest revenue, which is a current asset. Now, this might look really familiar. This is basically the same way that we handle our accounts receivable, where we increase our sales revenue and we increase a current asset that isn't cash. And you'll note that at the end of the year, just like normal, we close off our revenue account. The impact of this is that we're going to be recording $250 of extra revenue, which is going to increase our profits, and we're also going to have accrued interest revenue under our balance sheet, which again is going to increase our assets. Here you can see the impact on the ledgers. These are the entries that we've just put in. Now, unearned revenue is going to seem a little bit more foreign. This is a situation where we've been given revenue, but we haven't actually earned it, which means we might have received a payment in advance or a deposit or things like that. Now, when this occurs, we have to acknowledge that we have a liability. We have an obligation to fulfill a service or provide goods. So the example we're going to follow with is that a theatre has received cash in advance for live shows. So during a period, it receives $100,000 for 10 shows, but by balance day, it's only performed 3 of those shows. So do we acknowledge the entire $100,000 as revenue? Or do we acknowledge that we still have to provide a service? We still have to provide those shows. The accrual basis of accounting says that we're only going to be acknowledging the revenue that we've actually earned. It's only once we actually earn that revenue that we transfer it out of our current liabilities into our revenue accounts. So this is what the adjustment would look like. So the initial entry would be that we'd receive $100,000 in cash, and we would actually create a current liability called unearned concert sales, and that would also be $100,000. And what we do is, as we earn it, we decrease that liability and increase our revenue. And you can see that when we get to our closing entry into P&L, it's closed off that $30,000 as expected. Having a look at the ledger accounts, you can see the following. You can see that our revenue account has closed off $30,000 to the P&L summary. And you can see that there is still $70,000 sitting there as a balance in our current liabilities. Now, another common example is we might receive a deposit as a retailer. And the question is, how do we actually treat this deposit of cash that we've been given? The important thing to note is that deposits don't actually include GST, but they do represent unearned revenue, as it's been received in advance and we haven't provided anything in return for it. So let's look at an example where we've received an order for 30 coffee tables for a motel. These coffee tables are worth $500 each, plus GST, and they're made at a cost to us of $250. Now the catch is, instead of receiving $15,000 plus GST at the end of the sale, we've actually received a deposit of $3,000. And it wasn't until the end of the month that we actually delivered these coffee tables. So how do we account for this? The first thing we need to do is we need to record the deposit. And that's really straightforward because all it's doing is increasing cash at bank and increasing that current liability account. We don't have to worry about GST at this stage. Once we actually issue the sales invoice, it might seem a little bit more complex, but if you look at it, it does still work out like a normal sale. We have our accounts receivable of Money Valley Motel of $3,500. Now, you might recognize this as being the $16,500 that they would have owed us for all the coffee tables minus that deposit. Now, that was entirely sales revenue, so you can see that in this case, we're increasing our sales revenue by $12,000. We are acknowledging all of the GST, and we're acknowledging the cost of sales of these coffee tables. Now, you might be saying to yourself, wait, we earned $15,000 of revenue from this sale, but we've only acknowledged $12,000 of it so far. We've got $12,000 of revenue and a $3,000 liability. What are we going to do? This is where the balance date adjustment comes in. This is where we transfer it out from our liability and into our revenue account. So we've now recognized this deposit as being earned, and we can actually acknowledge that we have revenue now. So you can actually do a bit of a reconciliation on this account, and you can see that all the amounts are accounted for. So we have our sales revenue, which totals up to $15,000. We have the account receivable account, which will be $13,500, which is the $16,500 that they would have owed in total, less that deposit. So that's all we really need to cover. So what I'll do is we'll go to the wrap up and I'll leave you with the questions that you've got to get done. So what we're looking at today might seem a little bit foreign at first. With accrued revenue, we already know the processes that we need to go through and we know the accounts that need to be used. When it comes to unearned revenue, this is actually not too dissimilar. We have acknowledged that our accounts receivable does get turned into cash, and we have acknowledged that they will eventually pay off their debts. All this is kind of doing is paying off their account before they've even received the goods. So none of the accounts that we're using should feel too foreign. I'll leave you guys with the questions that need to get done, and I look forward to seeing you in class. Bye.